title is The Tale of Two Markets. And I put that on the title for one very important reason. There's two big asset markets in the world, right? There's the bond market and the equity market. One could argue real estate's another market. It's also very big, not quite as big as the bond market or the equity market. So what we have is we have signals from the bond market telling us that we should be a little nervous. And we have signals from the equity market telling us that we should be very excited. So the question is, we've got two different tales coming from two different markets. And today we're going to try to resolve those tales into a single story so that we can kind of understand where we're coming from when we're managing portfolios. Again, as always, there's an agenda. We're going to talk about where we've been, where we probably are, and where I think we might be headed. Okay, so really there's lots of different ways to look at data, right? And so we have this guy here. Who's this guy? Does everyone know the guy's names? I don't know their names. And they're minions, but which ones? No one? I wanted to call him Kenny. I wanted to call him Kenny, but that's a different comic strip. Different comic strip. He says, "Run for your lives." What he means is, run for your lives. It's good for you. Perspective. Okay. So because we have perspective, we're going to start with the partisan effect, and we're going to go general, and we're going to go specific. So in general, does anyone know what a correlation is? Does everyone know what a correlation is? If you saw a dot plot like this, and there was a correlation, you'd see kind of a line, and you'd see the dots kind of fall along that line. There's not a lot of correlation here, okay? So what is this chart telling us? On this axis here is the share of the population who think their country's economic state is good, right? So this is the people who are comfortable with their economics. And notice, pretty evenly split between the two. And then here is GDP. And there's always an outlier of someone that's really not doing well, but everyone else is kind of 1% to 7% in the range. There doesn't seem to be a correlation between how we feel about where markets and economies are going and where they end up going, okay? So that's important when we factor this in. So in our forecasts event in January, what do you think the topic of conversation was? And actually since November of last year, everyone thinks the world is going to hell because of our new president. And the world might be, but the market and the economy don't care. The market and the economy are immune. We had dozens and dozens of conversations. 3 or 4 really stand out in my mind about this time frame. Only one will I consider a failure on my part, where somebody said, "Listen, Jonathan, I can't deal with it. Nothing you can say will keep me from making the choice of getting out." And I think it was a week ago, 2 weeks ago, that person called up and apologized. Because there's nothing I can do. And I was like, well, I'm not going to tell you when to get back in now, because that'd be crazy, right? But this feeling, notice, this is Trump elected. There's half of the country thought it was great. A quarter of the country thought we were all going to go down. And then there's people in the middle. And notice the people in the middle, there are always some people in the middle. The independents sort of don't take sides. They sort of weigh in. None of them are right, because none of them have any idea what's going to happen next in GDP, in the markets, in economy, and the president doesn't control that. And I just want to lay that out there. And we're going to say this over and over and over again, probably for the next 3.5 years. Like that'll probably be part of the conversation. So this is actual GDP. We had a bad quarter in there, 2014, first quarter, and this is the stuff that makes it up. We've been growing slowly for a number of years, which sort of makes us think that we could continue to grow slowly for a number of more years. And we'll talk more about that in a second. So notice the parts that are positive. Consumer spending's positive, infrastructure, investment, fixed investment, both residential and non-residential, is positive. Exports, obviously that's a positive, pretty much netted out by imports. This says that probably whatever Trump wants to do with that, or whatever the Republicans, not Trump, want to do with that, we have just as many exports as imports. In fact, a little bit more exports than imports. We don't want to hurt our export businesses, and anything he does in that regard probably would do that. So we got to be real careful there. So that's one way that he could affect the economy. Some people benefit, some people suffer. In that case, as a general investor across all things, we would be fine. And then we have down here government spending. So short of an infrastructure project of some sort going through, this will continue to be negative under this president. He's going to spend less and less and less. Okay. But this is the economy. This is employment. This is sentiment. This is inflation. I don't like to make these things this busy. There's a lot of data here, a lot of stuff going on. But just in general, how unemployment works is you have an event, you have a recession, and unemployment shoots up, and then it slowly tapers down over time. At the end of its slow taper, you see wages go up, which is what we're seeing right now. We're seeing more wage competition. We're seeing there's sort of 3 employment statistics we can look at. There's 6 million job openings, more job openings than existed for a long, long, long time. There's more people quitting their jobs. Usually you do that when you find new jobs. Wages are going up. People are finding a better wage. They're going to that wage. So this is the end, or not the end of a cycle, but this is what happens naturally when employment gets tighter and tighter and tighter and tighter. And that's what we've seen. We shouldn't be upset by this. This is a beautiful place to be in the economy. This is also just very generally positive. And when people feel good about things, they spend money, they find new jobs, they start new businesses, they renovate their homes, they're active in their communities, they give more money away. So this sentiment is a very positive indicator. And the fact that we've had low inflation, this is the Great Recession, we've had relatively low controlled inflation since then, right? So yet you read the papers and you talk, and we'll talk about a couple of these people here. The end of the world is nigh, the end of the world is nigh. I don't see it. I had a conversation today. Yeah, well, Trump this and this and this, and I was like, no, let's talk about real data. And the negative isn't showing up in the real data. I realized after I put the slide together that this is a poorly designed slide. It looks like Janet Yellen is saying this, and Neil Kashkari is saying this. That's not what it is. It's a single quote. Neil Kashkari is saying, on the one hand, such and such makes sense, and you can kind of see, I'm inclined to believe the logic of the Phillips Curve, tight labor market should lead to competition for workers, which leads to higher wages. Higher wages lead to higher costs for the companies and higher prices for consumers. That makes intuitive sense. That's the faith part. But then what he says down here is, but on the other hand, the data isn't showing that. It's not coming through in the data. We're not seeing higher prices to consumers. We're not seeing the wages go up. This was an argument against. He was the one vote opposed to raising the rates this last time. They raised the rates. They're probably going to continue raising the rates because he doesn't actually control it, but he was the dissenting vote. We're going to spend just a very short period of time on this. So you have right here, you've got emerging markets. Here you've got the US. Here you've got Euro Stock 600. Here you've got Japan. Here you've got the UK. All of them positive for the year, right? Japan has got some issues down here, but everything's positive throughout the year. And that's because of this, corporate earnings. So the last earnings reports for the first quarter showed a 14 to 18% on average increase to earnings. More important than that, the increase in earnings, we've talked about this here many, many times, the earnings can come from 2 sources, right? We can cut costs, and largely since 2008, that's what's happened. We've been hoping for increased revenues, hoping for increased revenues, hoping for increased revenues, and now we're starting to see increased revenues. So a big chunk of the increase in earnings, again, 14 to 18% increase in earnings for these S&P companies has come from increase in revenues. That's a big deal, and that's a relatively recent change. And you can kind of see this is what earnings expectations are. This is March. This is the dark blue line. In every industry, except for telecom services, it's a positive trend. So we actually expect earnings to improve, and we're going to see in a little bit later another slide that says the same thing. So everyone talked about the Trump bump, right? So to be clear, there was a pretty steady growth of markets prior to Trump even being elected. And then after Trump was elected, we had a pretty steady growth in markets. I don't see a Trump bump generally. What we see is we saw here, this is the top line, the light blue line, is companies paying high taxes. And this line, you see a littler bump here, is infrastructure companies. So in these 2 groups, you saw a bump. But notice that bump has declined since that time, right? And so here is forward expectations. We thought, oh yeah, it's great. And then wait a second, not really, right? And then here we see the expectations of these 3 things, right? The tax cut, the Obamacare mandate shift, and then the corporate tax cut. And expectations were 80, now they're around about 40, a little bit below 40. Market expectations of participants have tempered, and yet the market keeps going up. Why is that?
What's the measurement of the expectations there?
Survey expectations. Yeah.
Of investors, of individuals.
Yeah, of individuals. Yeah. Okay. Back to bond market. Shift gears to the more difficult conversation. So here is the 1982 peak in the bond rates. Okay, and for 30 some years, we're down here at 2.27. For this last 3, 4, 5 years, everyone's talked about rates are going to go up, rates are going to go up, rates are going to go up. I've been part of the group, rates are going to go up, rates are going to go up. And I still think rates are going to go up. Eventually, rates are going to go up. That's the only place they can go. And that part of that argument is we can't go any lower. And part of that argument is we are creating an inflationary environment. And I think they're going to go higher now precisely because the Fed's going to do a couple things. The Fed's going to raise short-term rates. Going to continue to do that 3 times a year for the next 4 or 5 years because they want to normalize. They're also going to normalize their balance sheets. And one of the later slides, we're going to talk about that as well. Here's just a slight breakout of this later part of here, okay? This is the last 3 Fed rate hikes. When the Fed hikes rates, you expect the bond market to, or the rates to increase. Not what happened. So they hiked here, market fell. Kind of came back up, they hiked there, market fell again. They hiked here, that's what we expect. And now we're up at 2, actually we're up here, 2.223-ish on the 10-year. We're finally seeing the bond market react in a way that makes sense. And so we're going to talk about yield curves. There's a thing called everyone know what a yield curve is?
No.
So there's short rates and long rates. And there's a curve, meaning when you have a 6-month or a 1-year treasury, you're going to not expect a big return because it's 1 year out, you're going to get your money back. You have a 30-year treasury, you're going to expect a larger interest rate in the meantime because you got to wait 30 years to get your money back, right? That just kind of makes sense. However, as that curve flattens, let's say you can get 3% return on a 5-year or 3% return on a 30-year, that's a entirely flat yield curve. That's a scary situation. Companies don't know how to finance. We don't know what direction things are going. You lose the metrics of what's happening in markets. So we're getting a flatter yield curve because low rates are going up, whereas long rates, have you seen long rates? Have anyone tried to refinance in the last 6 months their homes? Rates went down to ridiculous levels in like October, November of last year, and then they went up, and now they're tapering down again, which is an interesting factor. So the long rates are still low, short rates going up. So that leads us into maybe we're getting to a point where we're going to question things, another bond market warning sign. Okay. And rates are low everywhere. I mean, the only place that's still lowering rates is Russia because they've got very specific problems. But everywhere else is starting to raise, but they're raising from a very low spot. Look at the euro area, 0.00000. There's no interest.